In this week's video, we'll use correlations and long-term historical charts to help us answer the question, will rising interest rates extinguish the bull market in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll be focusing on 4 major questions. Question number 1, how concerned should we be about rising interest rates? Question number 2, how helpful are interest rates in terms of monitoring the stock market's health? Number 3, is it possible for stocks to rise during a period of multiple Fed rate hikes? And given the Fed just raised rates again on Wednesday, March 15th, we'll close the video with this question. Does the 2017 stock market look vulnerable to rising interest rates? We'll quickly walk through some charts and then tie the charts back to our questions. Looking at the yield on a 10-year Treasury bond is a good proxy for interest rates. So here we'll be looking at the S&P 500 and 10-year yields, aka interest rates. In June of 2003, the 10-year yield was at 3.3%. And if we fast forward to June of 2007, the same 10-year yield had risen to 5.2%, which means from point A to point B, interest rates were rising. How did the stock market do over the exact same multiple year period? Quite well. The S&P 500 from the same point A to point B tacked on an additional gain of 60%. If you prefer to see the day-to-day volatility and the path from point A to point B, we can do that too. These charts speak for themselves and help us answer this question, admittedly from an anecdotal perspective. How concerned should we be about rising interest rates? These charts also help us with, is it possible for stocks to rise during a period of multiple Fed rate hikes? Over this same period, the effective federal funds rate, aka interest rates in another form, the funds rate rose from 1.24% inside of calendar year 2003 and peaked out at 5.25% in calendar year 2007. From 2003 to 2007, while the Fed was raising rates, the stock market did quite well. Now we'll use the concept of correlations, which will allow us to look at hard data rather than opinions to help us answer how helpful are interest rates in terms of monitoring the stock market's health. Prior to looking at the correlation between the S&P 500 and interest rates, we'll look at some correlations that are positive and some that are negative and some that aren't particularly helpful. We might guess that the S&P 500 and the NYSE Composite Stock Index would have a positive correlation since they're both U.S. stock indices and they typically zig and zag together. This is what that looks like mathematically. This is the correlation here. You can see it's consistently high. According to stockcharts.com, the correlation coefficient, which is what we're looking at here, oscillates between -1 and 1. In general, anything above 0.5 shows a strong positive correlation. And you can see the correlation between the S&P 500 and the NYSE Composite is for the most part consistently above 0.5 between 1981 and 2017, telling us that we have a consistent and positive correlation. Therefore, if you owned SPY, if you track the health of the NYSE Composite, it might give you insight into the health of the S&P 500. All things being equal, if we own SPY or the S&P 500, we would prefer to see the broader NYSE Composite look healthy as well. It's not necessarily a showstopper, but it can help us with confidence. This is what a strong positive correlation looks like. And to illustrate the concept of a negative correlation, we can look at the S&P 500 relative to the Ridex inverse S&P 500. By definition, one of these should zig and the other should zag, hence the term inverse. What does that look like mathematically? Pretty much exactly what we would expect. It has a consistently strong negative correlation, telling us that when the S&P 500 zags, typically the Ridex inverse S&P 500 fund zigs. According to stockcharts.com, the correlation coefficient oscillates between -1 and 1. In general, anything below -0.5 shows a strong negative correlation, and that's exactly what we have here. It's consistently below -0.5, telling us if we owned the S&P 500, it would be helpful potentially to track the health of the Ridex inverse S&P 500 fund. If the inverse fund started to get healthy from a technical perspective, that's not what we want to see if we own SPY. And again, we're using this as an anecdotal and hypothetical example to illustrate the concepts of positive and negative correlations. Correlations that are helpful need to have two components. They need to have a strong correlation and, maybe more importantly, a consistently strong correlation. And we can use an example to illustrate what inconsistency looks like from a correlation perspective. Now we're looking at the correlation between the S&P 500 and the VIX, or the Volatility Index. We showed earlier that a consistently strong positive correlation can be helpful. And with the inverse fund, we just showed that a consistently negative and strong correlation can be helpful. In this case, we have some serious inconsistency, telling us that tracking the VIX relative to monitoring the health of the S&P 500 can be moderately helpful at times, but it can also be confusing and even dangerous. Why is it dangerous? Because if we believe that the volatility index has a consistently strong negative correlation to the S&P 500, and that starts to change, it can hurt us. The VIX doesn't necessarily zig all the time when the S&P 500 zags. Therefore, if we were using the VIX to track the S&P 500, we could get some signals that not only didn't help us, but they could actually hurt us. So to summarize, a consistently strong correlation can be helpful, S&P 500 versus the NYSE Composite. A consistently negative correlation can be helpful, S&P 500 relative to the Ridex inverse S&P 500 fund. And something in between can be moderately helpful at times, confusing at times, and maybe even dangerous at times if we think the correlation is consistent, when in the real world it might not be consistent from a mathematical perspective. Therefore, if we're trying to determine how helpful interest rates are in terms of monitoring the health of the stock market, this is the unhelpful territory that we want to avoid. And what we're looking for is consistent white space. The correlation never goes into this area here over a long period of time. We have a positive and consistently high correlation. We have a negative and consistently low correlation and a lot of white space above. We either want this or this. We really don't want something in between. Therefore, it's prudent to ask, how does the correlation of the S&P 500 relative to interest rates look over a long period of time, understanding this is the area of confusion and possibly dangerous confusion that we want to avoid. And the graph puts some hard mathematical data, no opinions here, around that question. How helpful are interest rates relative to tracking the health of the S&P 500? We have a lot of that avoid look that we don't want to see. And we do have white space here, and we do have white space here. But remember, we said it's extremely important to have a consistent correlation. Notice here, from 1981 to 2017, we have white space the entire period. Not so here. Our white space flips in a very confusing manner from the top to the bottom. We're inconsistent, we have white space, and then we don't have white space for a long period of time. We have white space for a long period of time here, but it really doesn't look anything like this long period of time. Therefore, under our approach to the markets, we don't really track interest rates all that closely relative to trying to monitor the health of the S&P 500 or the stock market in general. Since we all have limited amounts of emotional and mental capital, we have to be very, very careful using limited resources on something like interest rates that not only can be confusing, but it can be very, very dangerous relative to trying to track the health of the S&P 500. Sometimes interest rates and the stock market zig together. Sometimes the stock market zigs and interest rates zag. Sometimes interest rates zig and the stock market zags. We're much better off expending our emotional and mental capital looking at things that have consistently high or consistently low correlations to the general stock market. In the remainder of the video, we'll review numerous 2017 charts to help us answer the question, does the 2017 stock market look vulnerable given the Federal Reserve raised rates again on Wednesday, March 15th? We'll start with this set of generic and for illustrative purposes only daily moving averages. This is the 30-day moving average here in blue, and this is the 275-day moving average in silver. In terms of a generic concept, this is a full bore bearish look with blue, the fastest moving average on the bottom, and the slopes of all of the moving averages are rolling over. We can see this late in calendar year 2000, and after this point here, the S&P 500 dropped from 1315 approximately down to 776, which represented an additional loss of 41% after we could see and measure that low probability full bore bearish look. Similar situation here. Early in calendar year 2008, the S&P 500 dropped from roughly 1325 all the way down to the exorcist low of 666. That represents an additional loss of 50% after we could see that full bore, low probability bearish look. Therefore, we can learn something about the present day by looking at these two extremes where the market is rolling over and see how the exact same moving averages look in the present day. Clients and regular viewers may remember we asked the same question back on January 13th, and the answer told us to try to be patient with our longer-term stock-related positions. If we fast forward to March 17th of 2017, you can see the present day look really doesn't look anything like these full bore bearish looks. In fact, what we have is a full bore bullish look with blue the fastest moving average on top and silver the slowest moving average on the bottom, and the slopes of all of the moving averages are positive. I want to make it abundantly clear we are using this wide range of daily moving averages to illustrate basic concepts, and the main takeaway is we have strong trends currently on multiple time frames. When multiple time frames align, the probabilities are more favorable. We're using something as fast as the 30-day moving average for illustrative purposes only. We do not use something as fast as the 30-day in our longer-term model. Similar situation, we used these moving averages back in January to tell us that the Dow still looked healthy. We have a similar situation on Friday, March 17th. From a breadth perspective, the broader VTI ETF, the total stock market, looked healthy back on January 13th. And the same can be said on March 17th. This tells us that the probability of good things happening looking out weeks, months, and years is favorable. It doesn't tell us much of anything looking out hours and days. The equally weighted S&P 500 ETF RSP looked good in January, and it still looks good today. Does everything look rosy on March 17th, 2017? If we're examining a chart like this, the answer is no. This chart has a full-bore bearish look at 1:53 p.m. on March 17th, 2017, with blue, the fastest moving average, on the bottom. Slowest moving average is on the top, and the slopes of all of the moving averages are down. What can we learn about the present day tolerance for risk by examining this chart? The chart we were looking at is TLT bonds relative to stocks, and it tells us something about the conviction to own defensive-oriented bonds relative to the conviction to own growth-oriented stocks. If we were concerned and the market was shifting to a defensive bias, we would expect this chart to have more of a turn-up look in favor of bonds. Is it possible that this chart improves? Absolutely, positively, yes. But from this point here, it has a lot of work to do from a mathematical perspective. And if we flip that ratio upside down as we did in November of last year and look at SPY relative to TLT on a monthly chart, we can see that back in November we had this favorable look to monthly MACD with the bullish cross of blue over red. Back in November, this look here looked a lot more like the favorable look near the bottom in 2009 and really didn't look anything like this unfavorable look in calendar year 2007. How does the same ratio with MACD on a monthly chart look today? The answer is still favorable. This look here looks very, very similar, or much more like the right side of the screen here, and really doesn't look anything like the lower probability look late in calendar year 2007. And as we've noted on Twitter numerous times, looking at something like a new all-time high in the stock market in isolation tells us very little about the market's risk-reward profile, and we know that new all-time highs can be made for literally years. This is 1982 on the left side of the chart, the S&P 500, and this is calendar year 1999 on the right side of your screen. And we know with 100% certainty, even in the context of strong bullish trends, we're going to have inevitable givebacks in periods where we feel uncomfortable. The financial markets are very adept at making people feel uncomfortable. We can't control that, but we can manage it from a risk management perspective in terms of looking at the probability of good things happening relative to the probability of bad things happening. The volatility in this chart is very, very distracting, and we know that if we add in trend following tools such as moving averages, that can help us filter out that day-to-day volatility. In this case, we're looking at the 100-day, 200-day, and for illustrative purposes only, simple 300-day moving average in green. The only way to capture the 16% gain from point A to point B for the most part was to ride out the inevitable volatility. And that's exactly what these trend following tools help us do. We've spent a great deal of time over the past few weeks and months mentally preparing ourselves for pullbacks that we know are coming at some point. And the model and the risk-on, risk-off ratios and the moving averages can help us discern between volatility to ignore and volatility to respect. At some point, these moving averages start to roll over, and we would move into volatility to respect. The chart we're looking at here is as of August 14th, 2013. It's fair to ask, how do the same generic and for illustrative purposes only moving averages look today? Remember, we used them back in February to say that we were maintaining a full-bore bullish look, and for the most part, from a probability perspective, things looked good. If we fast forward to Friday, March 17th, we still have a full-bore bullish look with blue, the fastest moving average on top, green, the slowest moving average on the bottom, and the slopes of all three moving averages are positive, telling us that the probability of good things happening relative to the probability of bad things happening still remains favorable from a long-term perspective. We also know that the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. It looked like we were getting a false breakout before the U.S. election, and then stocks rallied, which these moving averages helped us keep an open mind about, and now we're back above this long-term base. Thus, when the inevitable volatility arrives, we know that the only way to properly use these tools and the model is to monitor and adjust rather than anticipate and hope. And the only way that we can do that properly is if we head into next week and every week with that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.